Welcome to today's Explainer. We're currently looking at a market right in the middle of a massive structural transformation. And today, our analysis zeroes in on one very specific player navigating these incredibly turbulent waters. We are executing a comprehensive financial teardown of TechSeed's cybersecurity. Using data pulled straight from their recent earnings reports, M&A trends, and corporate filings, we're going to examine their structural pivot. They're shifting from a traditional services firm to an AI-native product platform, and we need to figure out exactly what the hard numbers say about their execution.
Okay, let's dive into this. Here is our roadmap. We'll start with the macroeconomic market shift, profile Technology Ltd, analyze their AI pivot, break down those financials, and finally look at valuation and shareholding. Let's get right to it.
Section 1. The cybersecurity market shift.
Right, so to understand any company's trajectory, we first have to understand the market's gravity. And this industry is shifting rapidly. As a recent M&A report diagnosis, and I'll quote here, traditional pen testing and consulting delivery is increasingly automatable. Those that remain purely human-led face compression. Think about that for a second. Private equity is aggressively consolidating the services layer. With around 500 cybersecurity M&A transactions globally in 2025 alone, independent firms relying heavily on just human capital are facing serious margin compression. They are literally being forced to adapt, integrate automation, or risk total obsolescence as the bigger PE-backed platforms build out these massive end-to-end offerings.
Now, the financial stakes of this shift are absolutely glaring when you look at market valuations. High-growth cybersecurity businesses, the ones with credible AI integration and recurring revenue models, they're trading at huge premiums, like 6x, and sometimes even north of 20x their revenue. It's wild. Conversely, the low-growth, traditional service-heavy firms, they're barely scraping by, struggling to maintain multiples around just 3x. So the gap between these two models is basically the crucial difference between getting crushed by margin compression or securing a premium valuation.
Section 2. Profiling Technology cybersecurity.
And this brings us right to Technology cybersecurity, trading on the NSE Emerge platform under the ticker TechD. They operate as an end-to-end cybersecurity provider, holding a critical Cert-In empanelment. For those who don't know, that's essentially a massive stamp of approval from the Indian government for IT security orgs. The company serves a really robust base of over 500 clients. We're talking government, enterprise, BFSI, and education. And they're led by Managing Director and CEO Sunny Vaghela, a major figure with over 17 years in the industry. His background is super interesting, ranging from actually assisting the police in major investigations like the 26/11 attacks, all the way to co-hosting MTV's Webbed.
Let's move to and see how this builds, because tracking their corporate evolution reveals a rapid acceleration. Founded back in 2017 as Tech Defense Lab Solutions, they operated for years just building up that traditional managed security and consulting base. But pay attention to the timeline here. In September 2025, they went public via an IPO on the NSE Emerge platform and listed at a 90% premium over their issue price. No small feat. Then, less than a year later, in May 2026, they officially launched their Technology Plan platform. It's a remarkably rapid evolution from a traditional, human-led services provider to a publicly traded entity actively pivoting toward product software.
Section 3. The AI platform pivot. That May 2026 platform launch is absolutely the critical inflection point. Technology recognized a huge pain point in the broader market. CISOs, Chief Information Security Officers, they're completely overwhelmed right now. They're often juggling 30 to 40 siloed security products from totally different vendors, creating what the industry calls integration debt. To solve this, Technology launched Technology One, which is a 7-module unified stack. The goal here is total convergence. Take their flagship Dark Vector AI module, for instance. It's designed for digital risk protection. Rather than manually monitoring threats, this AI-native product automatically crawls and gathers threat data from over 200 different sources across the deep and dark web, using AI to filter out all those annoying false positives. They are shifting the heavy lifting entirely from human consultants to scalable software.
And this brilliantly illustrates the bigger picture. It represents a fundamental shift. By moving away from selling third-party hardware or human-heavy consulting hours, they're establishing a highly lucrative subscription-based, AI-driven operational fabric. In theory, this kind of pivot protects their margins against automation, commands much stickier recurring revenue, and really positions them as a scalable platform rather than just your average regional service shop.
Section 4. Breaking down the financials.
Okay, let's look at the hard data. On the top line, the momentum is completely undeniable.
TechD reported revenue from operations of 51.8 crore for fiscal year 26. That is a massive 74% year-over-year surge. For a company right in the middle of a structural product transition, maintaining, let alone accelerating top-line revenue at this pace is a huge indicator of very healthy enterprise demand.
Drilling down into profitability, we're seeing a 46% increase in EBITDA for the first half of FY26 compared to the previous year, hitting 8.50 crore. Total EBITDA for the full FY26 reached 20.16 crore. Now, this metric is absolutely crucial. Why? Because it demonstrates that their revenue growth is actually scalable. They're actively improving their operating leverage and operational efficiency even as they expand.
And forward visibility looks incredibly strong too. The company reported a robust order book in hand of 40 crore for FY25 and 26. This includes recent wins in telecom and financial technology. And as we know, those are sectors where cybersecurity spending is basically a non-negotiable strategic priority.
Concluding this rapid-fire financial breakdown, let's check the bottom line, profit after tax. TechD delivered an FY26 PAT of 14.04 crore rupees, which is a formidable 68% jump year over year. The hard data shows exactly what we want to see. Their top-line surge is successfully filtering all the way down to net profit.
Section 5. Valuation and shareholding.
Now, what's really interesting about these metrics is the tension hidden inside them. On the balance sheet, TechD operates with an incredibly debt-light structure. We're talking a debt-to-equity ratio of practically 0.01 to be exact. They're funding their growth internally. This incredible efficiency is mirrored in an exceptional return on equity of 62.33% and a return on assets of 43.97%. Objectively, these are highly desirable operational metrics. However, the market isn't asleep at the wheel. They are well aware of this growth. The stock currently trades at a price-to-earnings ratio of 30.56. While high-growth AI firms can definitely command massive premiums, a PE of 30 is still considered comparatively overvalued in traditional metrics. It means investors are paying a fairly steep price for every rupee of current earnings.
Finally, looking at who actually holds the equity, it's clear the company maintains strong internal confidence. Promoter holding remains high and steady at 63.24%, with 0 pledged shares. That is a fantastic signal of management's belief in the long-term value. Public investors hold 29.85%, and we're also seeing the presence of domestic institutional investors sitting at 2.90%.
So, the crucial point is this. TechD Cybersecurity has clearly recognized the fatal flaw of remaining a purely human-led services firm. They've aggressively and successfully executed a pivot toward an AI-native, unified platform model, delivering a staggering 74% revenue growth and a zero-debt balance sheet in the process. The operational execution is definitely there. But with a PE multiple stretching past 30, we really have to ask, has the market already fully priced in the success of this AI transition, or is this valuation simply the new baseline for a newly forged high-margin software platform? Thanks for joining me for this financial teardown on The Explainer. Catch you next time.